Good day, everyone. Well, earnings projections by companies remain bullish, and unemployment remains near record lows at 3.5%, while wage pressures remain low. So this is kind of a nice spot for the markets, and we've got the big tech that have all laid off well over 10,000 employees, from Google to Amazon to Apple, Facebook. But nevertheless, earnings projections remain strong, and that's going to change because it always does. Companies need to start ratcheting down their projections as the recession takes hold, or let's say the slowdown takes hold. But so far, the GDP number was revised higher today. There's just signs of continued strength in this market, and this is not unusual. It's kind of the calm before the storm. Seen this before. Same with unemployment. It tends to bottom right before the recession really takes hold, and then it starts to soar. And I think it's going to probably play out. I don't see why it's not going to play out in a similar way as it has in pretty much every single recession going back decades. Keep in mind that earnings projections are a lagging indicator, but you do see major names like UNH, United Healthcare, if you look at if Gil, you can pull up a weekly of UNH, and what you'll see is that if you go back to COVID times in early 2020, that was the last time UNH broke below a critical moving average definitively, and now it's doing it again. And you can also see with Johnson & Johnson, it's J&J, or Procter & Gamble, PG, they're starting to all report disappointing earnings. So I think it's a matter of time before other companies are forced to lower their earnings projections, and the majors remain below their 200 DMAs. NASDAQ is right up against it right now. And we've seen it hit the 200-day. Well, it's done it, let's see, 3 times in this bear market. And every time it rolled back over and plunged to new lows. And it's the weakest of the indices, it's a risk-on indices like the Russell 2000. So both of those are lagging the Dow, which is a risk-off, or it's a defense index. And no new bull markets start this way. So I'm expecting it's a matter of time before we see these markets turn back down. Lower highs and lower lows remain on course, as you can see in the majors. Big tech have lost 1/3 to 2/3 of their values off the peak. And despite the rising rates, M2, that's the money supply, one of the main measures, it increased in the fourth quarter of last year. So in other words, the Fed has ways to print money in stealth fashion, despite hiking rates, much as the Bank of England did late last year. And I call it QE light. And this in part contributed to the bounce we saw in the fourth quarter of last year in the majors. And this suggests that despite the possibility of persistently high inflation, this QE light can continue and can result in choppy sideways, go nowhere markets where there's no material trends in either direction. But I think it's more likely, instead of that playing out, that markets are going to roll over and start into new downtrends, and it's going to force the Fed to pivot by halting the hikes than actually reducing rates. And if history's any guide, the markets will continue lower as rates fall. And this was the case in the major bear markets where bubbles had to be unwound, such as early 2000 and the early 1930s. And the other scenario that could play out is a black swan, which forces the Fed to launch QE5. And that could restart the bull market depending on how much money is printed. Certainly, if we get the level of printing that we saw at COVID or during the financial collapse of 2008, it's off to the races again. But maybe the black swan isn't that dire, and maybe they don't print as much. So we'll have to see. And tomorrow's PCE report is likely to reflect a continuation in the fall of inflation. Rental prices have been stubbornly high, but that component makes up a smaller part of the PCE than the 40% it comprises in the CPI. So this dead bat bounce could continue until I say one of three possibilities. First, if we get signs of an economy that's too strong, that ups the odds for more rate hikes. Or we get signs of a crumbling economy that take hold, and that, of course, creates fear that the Fed's behind the curve and they're going to have to really start lowering rates, but they're behind the curve, so the markets sell off. Or C, we get signs of persistently stubborn inflation in the CPI, PCE, or wage pressures. And that, of course, is going to keep the terminal rate elevated, or, as Goldman had predicted, it might cause the Fed to have to hike by 25 basis point increments beyond the 500 basis point terminal rate that's projected right now. So we're in a bad news is good news environment in this bounce, and I think that the major averages, they're recalibrating because they were quite oversold, and now they're digesting the recent positive news on inflation, but I think they're ultimately going to get ahead of themselves. And you can see on weekly charts of the majors that they really don't like to do much of a sideways move for very long. They tend to trend up sharply or trend down sharply because they're very news driven. And like I said, I think it just takes any of those three scenarios that I laid out just now for markets to roll over and start into a new downtrend. And I like the way the NASDAQ is illustrative of that. But if you look at the S&P, it's not quite as volatile, but it tends to also not want to move sideways for very long, and it tends to be in a trending fashion, up or down. So I don't think we go nowhere sideways markets per se. I think that's a pretty rare event. You'd have to have a balance on both sides of the bears and the bulls arguing which way the market should go. And I think there's just a lot of bad news that has yet to come because there's just a lot of stuff broken out there. So even if we don't get a black swan, I think that markets are headed lower, if we go out to weeks to months. Gil, how are you seeing everything?
I'm with you on that. I have my piggy indicators. The pigometer was going crazy yesterday. I mean,
I like that.
I've had my, as far as I can tell, and I've been going back and checking my records, this is the best January since year 2000 that I've had. Basically punch up, and I'm just doing a one, starting value to closing value up 40.3% in the last 3.5 weeks. So that's pretty good. But also what that tells me is that things are very piggy. And when things get piggy in this market, I don't view this necessarily as a trending market, although you could argue that the precious metal space has had something of an intermediate trend off the October-November lows. And in fact, that's what I've been playing on the long side for the most part so far this year. While at the same time doing this SOX S, SOX L, Tech S, Tech L strategy, and basically trading these in various directions. So right now I'm long the SOX S. So I puked out all my longs. I'm just hanging back, waiting to see what happens as far as the long side goes, and then throw out my Tech S, SOX S shorts. You can use SQQQ as well. They all pretty much tend to look the same. If you look at the SQQQ, SOX S is a little cleaner today. It's only slightly, but you did have the cross early in the day, boom, and it's off to the races from there. So it probably heads higher. You have the Tech S this morning, did the same thing, basically flipped out right at the open and headed higher. You had a little break here, but for the most part, another buy signal here at like 31.66, and now you're pushing above 32. If you look at the position of the NASDAQ, to get a sense of this. Now, the thing about the Tech L, Tech S combination is that there's a couple of stocks. If you look at the top 10 holdings in these ETFs, and I'm just going to go over here and pull up my lists over here. If I look at, I know it's in here somewhere. Give me a sec while I figure out what's going on. Here we go, ETF components. So here's the Tech S, Tech L. And of course, we got the buy signal here earlier this morning, but it has Apple in it, and you can see Apple's looking a little toppy in here. It's got Cisco, A little slow on the uptake there. There we go. And it's hanging around the 50-day line. Looks a little slightly extended. But it also has MasterCard and it has Visa. And so that gives it a little bit of a different shakeup. You also get Salesforce in there. Notice how it's shooting into the 200-day line. So that looks like a short to me. Accenture, I think it's just a tech IT company. Is that right, Chris? Do you know? Anyways, that was a short at the 50-day line on Monday, and now you're rolling back below the 20-day line. So, when I look at the stocks, they kind of tell me, let's look at Microsoft. Got hit yesterday, but it looks to me like it's in price resistance land. So you're along these highs. So that gets a little double toppy. So, the stocks seem to argue for at least in a near-term pullback in these names, which will result in a rise in the Tech S. And so I get long that. As I'm noticing these stocks run into resistance. If we look at the semiconductors, Broadcom has been running up for the past several days, but notice now you're in double top line. NVIDIA has been one of the biggest runners lately. It's starting to reverse. It's at the $200 price level, but that is not a century market. It's already been up and through that and back through it, and so it doesn't really become a factor anymore. You look at something like Qualcomm, and that's reversing up here today. So after punching into higher highs. And let's see, analog devices along price resistance at 170. So you can see that. So yeah, they get them running, but still fundamentals don't really matter. It's just an area that money flows into because it's got nothing better to do. And the assumption is that when the Fed pivots, everything magical is going to return to the market on the upside. And I think that that's a flawed assumption. Because we talked about this last week, and that is that when the Fed starts raising rates towards the end of a bull market, and you don't know that it's the end of a bull market, but the Fed starts raising rates at the end of a cycle, and it takes a couple, three rate hikes in a stumble or something, Chris, something like that?
That's the saying, 3 steps in a stumble, because historically that it tends to average out that way. And we've gone way above that. I mean, the Fed did 4 unprecedented 75 basis point rate hikes in a row, and we're and then more 50 basis points, and we're so beyond 3 steps. It's not even funny because we're so extreme.
So you cratered it. But my point is that it takes in the past it's taken a couple 3 rate hikes, and then once the market rolls over, you go into a bear market. The Fed starts lowering rates. It takes several rate lowerings or rate cuts to get the market going again. And that's because as what happens is you get to the end of the bull cycle, the economy's spitting out cash. Then when the Fed raises rates, it slows the economy down. And now everything contracts. And so liquidity becomes an issue for the economy. And that's the second stage. So that's the second wave of liquidity problems for the market, because if money is being sucked out of the economy, it takes a while for the Fed to inflate that again. So we'll see if this plays out the same way, but it's like Chris saying, anything weird could happen here because you're in a very weird period where you have very strange and unique and bizarre underlying conditions. So, anyways,
that's why they always say, like a broken record, the Fed over-tightened. They over-tightened. Well, they kind of it's a very difficult job that they have to do to if they don't over-tighten, then inflation could get away. So they'd rather over-tighten than under-tighten. And then what happens is that's 3 steps in a stumble take effect. And when they lower rates, the bear market is usually far from over. So as rates go lower and lower, and you can see this on 3-month T-bills, the market tends to trace the direction of 3-month T-bills. So, if the T-bills start to plummet, so far they're still in kind of a loose uptrend. Which suggests that interest rates will go higher. But once they start to go lower, they're the first indication that interest rates are going to go lower. And that's also the first indication that markets are also going to head lower. They're not going to just all of a sudden start into a new bull market, because we've seen, time and time again that the market does tend to follow the direction of rates. So when they go lower, then markets head lower.
Anyways, so, assuming that you get a Fed pivot or the Fed stops raising rates and everything's going to be beautiful again, I think it's probably asking for too much. We'll see. In the meantime, you got some pressure on the dollar from this de-dollarization movement that's going on around the world. And that's been positive for the precious metal space. So if we go there, How did I do that? Oh, I see what's going on here. I think link to all. Anyways, where was I? So you also have the NASDAQ up here running into the 200-day moving average. So that's probably going to be an area of potential moving average resistance. So that, that makes the argument for flipping out of the long side, taking profit since things did get piggy. And I just find in this market that it tends to trade in a contrarian fashion. So when things look all strong, that's usually the time to be selling into the move. And when things look weak, that's maybe the time to start thinking about maybe buying on some undercut and rally moves or voodoo pullbacks to moving averages. So in the meantime, I think this is all going to be very volatile, and it's really just a trader's market. It's still not. Let's get rid of the filter here. There we go. Still not really a trending market, but if I look at, say, miners, these have been trending very nicely. They're all pulling back today, so that all makes sense, right? And I think as they pull in, usually I like to get into pullbacks on down to the 20-day line, but you see something like Equinox Gold, maybe the 200-day line. Goldfield's coming, it's basically building a handle. The 20-day line becomes possible viable support. But if we do get into a hairy market sell-up, then I think everything gets taken down because, again, this forced selling will have to address liquidity issues. And so that's what I think you have to be very wary of. But basically, this is what's been running for me over the past month because everything broke out. And basically the first or second day of January, and then we're off to the races. So that's really where it's all come from. Sprinkled in at the same time is this Tech S, Tech L, Stocks S, Stocks L strategy that I work, depending on what the 620 charts tell me. So, and I think really that's the only way you can really practically or concretely operate in this market. Any questions? I've got some, let's see, what I got here. Let's look at possibly some short sale ideas. Crocs, maybe a short at the 10-day line. I'm watching Chevron. It's up. I think it's on earnings, but it's stalling up here in double top line. So I'm watching this one. It could potentially become a short. Ford was a short. We talked about these as shorts. Notice, though, as the market's rallying, it becomes a 50-day line where you run into shortable resistance today. General Motors also did the same thing, ran up to the 50 and the 200 where it became shortable again. So we talked about this in the weekend focused list review. Some other names, Dick's Sporting Goods, looks like a short at the 10-day line. If you bust the 20-day line, then you have a fresh short sale entry trigger. I'm looking at Silica. This is they make sand for that's already done. Yeah, I made this list probably an hour ago, but this one's working out here. Short at the 50-day line, heading lower from there. U.S. Steel Dynamics reported earnings last night, and it was up. But U.S. Steel reversing on a double top type move here. Little mini double top. It's only a couple of weeks long, but if it breaks the 20-day line, then you have a concrete short sale entry. Steel Dynamics reporting earnings last night, gapped up, and it's holding up on the gap. So I don't think I'd buy this right now, but I might watch for some kind of reversal. In the cloud sector, you've got Bill.com short at the 50-day line. You've got Salesforce, I already showed you this one, a short at the 200-day line. And in each case, the moving average in question becomes your covering guide. And when we say covering guide, you can use the moving average, or you can set 1 to 3% beyond the moving average as your selling guide. In some cases, you might have a situation like Microsoft. Let me just blow this up, where you're past the moving average, okay? And you're probably like, I'm going to guess 1% past the moving average. But also you end up with this peak here that can be used as a potential double top short entry, or this peak here. So that's another way to play it along price resistance if you have it in a very coherent fashion like you have here, and it's just above the moving average. So you can kind of alternate between all those. What else? Getting back to the cloud names. Alteryx is short at the 200-day line today. So some of these already came down. CrowdStrike, I think that's at the 50-day line. No, at the 20-day line. That can't even get rallying here. Splunk, I think this was at the 200-day line. Yeah, and that's still in position. Roblox, this one was on fire the last few days, I guess. It's gotten volatile. It seems to be shortable along those highs just above 37.50 or at the 200-day line today. And that may be one to look at. Zoom Telecommunications, short at the 50-day line. Here's an ag name, Agco, shortable at the 10-day line. If it busts the 20-day line and does so in decisive fashion, then you have a short sale entry there. A second one, I'm watching Alcoa, which has been all over the place now. It's been trying to snuggle into the 200-day line and hold as volumes declined. But now you're testing it. If you bust it, then you have a short sale entry trigger, although an aggressive short seller could have come after it at the 10-day line this morning. But you get a sense real quickly here that a lot of this stuff is seat of the pants, on the fly. You know, as I like to say, you got to have your dance moves down, because that's what this is. You know, it's like a big old freaking Watusi. And you're just going bonkers trying to keep track of all the 620 charts. That's one reason why I picked something to focus on. So on the long side, I focus on the precious metals sector, and also trading the SOX S, SOX L, Tech S, Tech L, as a way to play moves in tech names and semiconductors in both directions. Because what you'll notice, and the reason I focus on just using the ETFs, the leverage ETFs, is because if you notice, semiconductors tend to move together like a school of sardines. You know, they one's up, they're all up. You know, one's up big, they're all up big. One's down big, they're all pretty much down. Some of them down big. And tech as well. You know, when the big stock NASDAQ names get moving, they're all moving together. So instead of trading individual stocks, it's much simpler for me to watch an ETF on my 620 charts and decide what I want to do based on that, rather than having to watch a bunch of stocks like, you know, like I was showing you over here. In these ETFs, I don't, you know, if I don't want to short any one of these, but I can just play this instead. Same thing with the semiconductors. So I think it's a much more efficient and sensible way to handle things on the short side, because the stocks tend to correlate very closely as groups. And that's just something we've seen for a while. So that's one way to take advantage of it and simplify the process in terms of not having as much to keep an eye on. So anyways, but you know, that's what this market requires, and you really have to be on your toes, you know. So what else we got here? Let's see. Well, take a look at my list here. I think that's pretty much it. I could probably go through some other groups, and I'm sure at this point you're seeing some things start to break. But for example, I'll just pull this out. We'll make it bigger. Here we go. Boom, boom. Some groups that, you know, if I go through, obviously all the miners are coming in because the metals are coming in, and they've all had a nice run. So, you know, they have a run for a while, and then they're going to have to take a rest and reset. But if we look at, say, telecoms, for example, Arista looks like a short at the 50-day line, okay? Sienna looks like a short at the 10, and if it busts at 20, then that triggers another short entry. Extreme Networks is a dog. F5 looks like a short at the 50. Fabrinet's too thin for me. I don't like that one either. Juniper Networks, nothing going on there. Lumentum, nothing going on there. So that's that group. Now, if we look at, pick a group, any group. Here we go, Solars. Array Technologies, that was you notice the double top short. You actually, through this peak on the left side, you had a double top short sale set up here. There's your cover point at the 20-day line. It goes for it one more time on, what would that be, Monday? Or no, what's today? Thursday, right? Okay, so that would be Tuesday. And it flips out yesterday, and today you reverse to the 10-day line. That's an aggressive short sale entry. And now you're busting the 20-day line as you test the 50-day line. So if it busts the 50-day line, it's already triggered one short sale entry at the 10, one at the 20, and now we're looking at the 50 potentially. Okay, so here we go. NASDAQ's now turning red. I'm actually short some gold miners, by the way, and that just points out the fact that I play everything in both directions. Because that's, again, as I said, it tends to be a contrarian market where things get extended one way or the other. They'll tend to snap back the other way. And I think that shows up in the charts, because if you look at the NASDAQ, you've really just been in a big old choppy range for quite a while. And the same thing goes for the S&P, even though if you squint, I guess you can see something of a cup with handle, but that doesn't mean anything. Anyways, where was I? Any questions? I don't see any questions. Is anybody in the market right now? That's what I want to know. Oh, yeah, we're going through solars. So easily sidetracked. I'm also watching my positions. The Tech S making a higher high. Let's see if the SOX S does now. End phase, we can see this one. It's kind of in no man's land. First solar, it's holding the 20-day line, but guess what? You are basically in a recent breakout. My drawing skills are pretty weak today. Here we go. So basically, you're failing on this breakout. Okay, so now you're into the 10-day line. Could be a short there, using the 10-day line as a covering guide. And then if you bust the 20 and then the 50, well, now you're into a full-blown late-stage failed base short sale setup, and there you go. And you handle it accordingly. Let's see what else. Sunrun just getting smacked around. Solar Edge probably flipping out. Let's see, at the 10, 20, and 50, so kind of in a short zone. So there's a number of names you can pick and choose from if you want to short stocks, but essentially you go through your watch list, and most things that have been rallying have probably rallied into some area of resistance, which is either some sort of double top resistance or moving average resistance, and then you handle them accordingly based on the methods that we've discussed in the short selling book, Short Selling with the O'Neill Disciples. And that's pretty much it. Otherwise, I think you're in for a very volatile period, and you've got to be ready to, you got to have your dance steps down. End of story. So any questions before I wrap it up? Because that's pretty much all I have. Nada. Okay. Well, that's it for now, you guys. Thanks for showing up. Like I said, we think you're heading lower. So, if you're into trying to short this market, then pick your vehicles, pick your spots. I think my SOX S, SOX L, Tech S, Tech L strategy works. You can also use a TQQQ, SQQQ, and a variety of others, the SPXU and the SPXL on the long side for the S&P. So anyways, anything else, Chris?
No, my preference is, I think all those work, but I really like to short TECL because it tends to have less upside. It doesn't have the degradation.
Oh, you like to short this? Okay, yeah. I hear you.
Yeah. So also you get more bang for your buck on the downside compared to, say, TQQQ by a little bit. They obviously are very closely correlated, but you just get a little bit of an edge. The only thing to be mindful of is that TECL is pretty illiquid compared to TQQQ. So, if you're trying to short, I don't know, like a couple $100,000 worth or more, then you can run into some, you're going to get more slippage off size like that.
Actually, Chris, you know what? I've been trading this, and I can tell you that you really don't get any slippage at all. And I trade pretty good size,
I was just going to say,
20,000.
I was going to say it's when I do pre-market trades. So pre-market with TC.
Yeah. It is very thin after, yeah. So that's why I really only use it during the day. After hours, I think you're looking at the TQQQ, SQQQ is a better pair. And also the SOX S, SOX L tend to trade a little tighter after hours, a little more liquid. But yeah, you're right. After hours, definitely. All right. Anyways, that's it for now. We'll talk to you guys later. Have a great rest of your week. Take care.
So long, everyone.